Our first topic up this afternoon is a panel discussion. It's called The 5 Key Components of Your Succession Plan. And our speaker is Tere Stykalo, Regional Ag Leader with Myers, Norris & Penny. He is going to moderate the panel of experts who will discuss the 5 key components of your succession plan that will help you and the next generation succeed. These experts come from a field of tax, assurance, and consulting. Please join me in welcoming Tere to the stage.
Thanks, Nikki. All right, we got that fixed up. Anyway, I'd just like to welcome everyone to Ag Days 2020. It's certainly our pleasure to partner with Ag Days again to be part of this great 3 days that are happening every year annually. So, again, on behalf of our firm, again, we'd like to welcome you. We know that there's a lot of exciting things to look at here today. There's lots of green paint that we might want to go and see and check out, or blue or red, but you decided to join us here, so we're very thankful of that. As Nikki said, my name is Tere Stykalo. I'm actually reside in the Dauphin office of MNP here in the province. And you'll notice our colleagues were up handing out some placards or some cards. There's a lot of them circling around. So if you have any questions or anything after the event or after the speaking that we're going to do here today, please feel free to see any one of us. Also, just to let you know that our panel will be at our booth, which is located up on the main course after. So if you want to come and see us, if you have any specific questions that you may not feel like asking here in front of everyone, that's great. We'd love to have you come up there and meet with us. We'll be there for at least a good half an hour after our session here. Also, just like to let you know that there's other sessions happening. MNP has this theater for all 3 days. So tomorrow, I believe Stino Scaletta is talking about tax, and Peter Manis will be talking to you a little bit about some of the farm consulting that he does. So again, our topic today is something that we think is very relevant to folks, very relevant to producers, and making sure that you understand how important succession is. And we find that that's a topic that we deal with, whether you're talking about tax or whether you're talking about your profitability or whether you're talking about family dynamics. Succession is a very important part of the evolution of your farm and of your business. So, and this year we chose to have a panel discussion. We thought we might bring more, a little bit more dynamic to the stage here, so that we can actually address a bunch of different things that we think are very important. And again, we've chosen 5 different things. Every farm is going to be different, and you're going to have your own things that you need to deal with and work through. But we've chosen 5 of the most common things that we're hoping that you can take back to your farm and to your kitchen table and utilize in your operations, whether it be today or in tomorrow. So, and those are the thoughts that we're going to try to share with you. We really want to have some interaction from the audience. So if you have a question, please put up your hand and ask the question, because if you're thinking about that question, probably the person sitting beside you or across the theater is probably thinking of likely the same thing. So please do that, and we'd sure like to have that interaction. So just a quick poll here. How many people here actually have a succession plan? We got a couple. So fun fact, how many people in the country do you think actually have a written formal succession plan? Do you think it's greater than 20%, less than 20%, or greater than 50%? What do you think? Yeah, it's actually 14%. And the percentage of farms or families that have, kind of a plan in their head, right, which they're likely all in denial, but they have this plan in their head, is about 34%. And the remainder is about 52% actually have no plan in place, nothing. And when you think about that, it's kind of scary, right? And you think, well, yeah, but all those big farms, those 100,000 acre farms, they all got plans. No, they don't. We see that all the time, that those plans are far and few between, and I think that's probably part of our session today, is just try to make sure that you do have a plan. Succession or transition is certainly not an event. You just don't wake up tomorrow and say, I'm going to have a succession plan today and we're going to get it done. Although when you're pulling calves in 40 below or checking a heated canola bin, you probably hope that day comes sooner than later. But it's not certainly an event. And it's not one person's problems, and it's not just about minimizing taxes. It's not about equality. And it's certainly not there just so lawyers and accountants can charge you some money and get the job done for you. It's about you. It is a process. It's about your family. It's about your relationships. It's about management. It's about ownership. It's about planning your estate. It's about communication. It's about values. So that's what we're going to talk about today, and that's what our vision is going to be today. So I'm going to actually ask the panel to introduce themselves, and we're going to start to my immediate right with Mike Poole.
Good afternoon. My name is Mike Poole. I'm our regional tax leader for Southern Manitoba region. I've been with MNP for 18 years now, so I guess you'd call me a lifer. My role in our region and in our firm is to act as a resource for all of our clients and for all of our folks like Tere and Jen and Peter, just to help folks navigate the ever-changing and ever more complex tax laws that we're finding ourselves in, and hopefully keep a little more money in your pockets instead of sending it into the government.
I'm Jennifer Christensen, a partner with MNP I've been with the firm for 20 years, mainly out of the Dauphin office. I about 6 months ago moved to our Portage la Prairie office. I work for family farms on a daily basis and helping them obviously do their historical financial statements, tax returns, but also looking forward and making sure they're talking about succession and planning for the future.
My name is Peter Mattis. I'm the new guy here. I've been at MNP for 13 years. And I work as a farm management consultant, so I work with farm families in a variety of business consulting and analysis type roles, and specifically with farms and farm transfer, and some of the questions that we kind of have highlighted here today, just helping with some communication and structured business meetings.
Awesome. Thanks, guys. So what we're going to do is I'm going to ask the panel some questions, and they're going to try to answer them, and hopefully it'll stimulate some conversation or some questions from yourself. So please interact if you're able to do that. So obviously we've seen many different family meetings and various dynamics that play throughout those different types of opportunities that we've sat at folks' kitchen tables. Peter, what do you say is the biggest factor of having successful meetings? Because sometimes that's the hardest part, right? It's not necessarily making your plan, but it's actually having a meeting. What do you think is a successful meeting, let alone a sort of a successful transition or succession plan? So, Peter, what would those items be, do you think?
This isn't what we talked about, Terry. I'm just kidding.
I set him up.
We've got to lighten the mood a bit. I think first of all is in a lot of farm transitions, the biggest challenge, and when we think about ones that haven't worked, majority of the time it comes down to communication and this kind of clear goals and vision. And I think the first part is obviously to start having the discussions, whether that's with your farm family business or whether that's also with your family in general. Is just to have those conversations. And I think the second thing is structure. The things that makes you successful as business people is your ability to operate and make decisions relatively quickly, which means your ability to operate in a business without structure. The challenge is when we get to some of these really hard places and big life events is that we need some structure to force us to have some of those conversations that we wouldn't have otherwise. And I think that that's really a key is forcing ourselves to do that and forcing ourselves to differentiate those meetings between our family time and our family business time and understanding that there's a difference and structuring those things accordingly.
Yeah, communication is pretty key. I would agree. I mean, I've sat at a lot of different kitchen tables, and you've had some discussions, and sometimes you think, succession is kind of boring and, as Peter said, dry. But you sit at a kitchen table with some family that may not necessarily agree, and it gets a little more lively than you really want to have. You see some things happen that really it's hard for them to take back. So one thing you want to do is have that structure and have that opportunity to communicate effectively, right? And some of those meetings are really tough. So that's one of the things. So farms obviously take on many different structures, not only at the kitchen table, but actually from a tax perspective. How many people here would be incorporated? Yeah, all right. So corporations, partnerships, joint ventures, all kinds of different structures. We're going to pick on the tax guy right now and say, Mike, what would you say are the steps that you need to take to ensure that you're in the right structure? Because sometimes we'll say, hey, should we be in a corporation? Should we be in a partnership? Should we be in a joint venture or adventure of some sort? We're not quite sure. And if you're not in the right spot, or if you're not in the right structure, how the heck do I get there? So Mike, give us a bit of a story on that.
Sure. So one of the most common questions that we'll run into is that question about incorporation. Because there's really, if you boil it down, I mean, you can be a sole proprietor, you can be in a partnership, but ultimately it comes down to, are you paying tax personally on all of the farming income, or is the farming income being taxed in the corporation, and then you're being taxed personally on what you take out? And so that's a very common question that we get, but there are a lot of different factors to look at when you're picking the right structure, because it's not just, I should incorporate, go right to the end game. We have to think about a number of different things. So some of those things are the operating costs. Obviously, if you're a sole operator or you're maybe in a simple partnership, it's a lot less costly to operate that structure. It's a lot easier too. You're not having to deal with a lot of agreements and things like that. You're not having to involve lawyers and accountants and advisors as much. A really important one that we often overlook, and I know, and I'll get to the tax stuff, but there's the liability perspective. So if you're an individual or you're an individual in a partnership and something goes wrong on the farm and there's not enough insurance to cover it, you're wide open as far as your personal assets. Whereas if you're in a corporate structure, there's a veil there. You can reduce the amount of liability that you have personally. And that's a very important one, especially when we start thinking about having hired help working on the farm, operating heavy equipment. Accidents can happen, so that's something that we need to keep on the radar as well. But the big one is this concept of tax. And when you're an individual or you're an individual in a partnership, your tax planning is really limited to what I call traditional farm tax planning, which is your deferrals, your pre-buys, and then potentially RRSP contributions. So you're limited in that respect. And whatever that farm makes, regardless of how much you put back into the farm, you're taxed on it all personally. And what I have found in practice is eventually that runs out of road. The deferrals and pre-buys they don't work anymore, and we're on our way to incorporating. And the big difference there is a corporation, it pays tax at a much lower rate than an individual, and it leaves you that much more money after tax to do things like pay down debt, invest back in the farm, maybe buy that next piece of land or whatever it is that you're looking to do there. The last thing I want to say, though, is I think something that's really overlooked is farm partnerships. So if you're currently operating as an individual and you're using those traditional planning techniques, the deferrals and the pre-buys, and that's working for you, I would really consider getting into a farm partnership. And we don't have enough time to dive into that, all the whys for that today, but you're going to put yourself in a much better position when it comes time to incorporate. So partnership to incorporation, you're going to be way better off than individual to corporation. So those are some of the things that we look at, Terry.
So Mike, I have another question for you. So sometimes when we talk about planning and those kind of things, one of the things comes wills, perhaps. But when that's good for an individual or say a partner in a partnership. What about when we get into corporate structures? Is there a will for corporations, Mike?
Absolutely. So essentially, when you're getting into any more of a complex structure, you need agreements in place. So if it's a partnership, you should have a partnership agreement. If it's a corporation, you should have a unanimous shareholders agreement. And if it's a joint venture, you should have a joint ventures agreement. And then I'm sure we could go around and we could talk for hours about some of the horror stories we've seen when things don't go right. So these agreements are really the guide rules for what happens in certain situations. So a common one is, let's say we've got 3 brothers farming together in a corporation. And one of them says, you know what, guys, I want to be done. I want out. But there's no agreement in place that says how that person gets out, how their interest in the farm is valued, over what time period are they to get paid out. And without those guide rules in place, really the worst happens. Everyone goes and lawyers up, it becomes a fight, and the next thing you know, these 3 brothers won't talk to each other anymore. So it's critical to have, along with the structure for tax or whatever you're planning into, have those agreements in place and have them documented properly by a lawyer so that if the worst does happen, you know exactly how to deal with that.
I know, Jen, you've dealt with lots of shareholders agreements throughout your practice, and what do you think would be the biggest concern? Like sometimes we say, well, I'm just farming with my wife, or as Mike said, I'm just farming with, I'm farming with my brother, things will be okay. What have you seen?
Well, I think from what my past has shown me is that when everyone's getting along, we don't think about this. It's when, something happens in a family dispute that all of a sudden we're not getting along, not talking.
Yeah, and how many people have seen that? I have. I've seen that lots of times.
And it's unfortunate because it's, family starts to dwindle, those relationships, but also now the farm suffers, and that equity that you're passing on to the next generation or what is available might not be there because of those disputes. Yeah,
and estate plans as well become quite complicated. Not only corporations and these shareholders agreements and all these kind of things we're talking about today, but these estate plans kind of become quite complicated. And if we look at stats, they're going to be exactly the same as these succession plans, right? How many have them? There's going to be the same thing. 14% or 15% actually have a formal estate plan and so on and so forth. So, and the rest of the 52% have an estate plan. It's quite simple because they just don't have one. So, but Jennifer, so how do you approach someone's estate plan? Like, what would you cover? What do you think would be some of the most important things that people need to think about as they think about estate plans? And you don't have to be 80 years old to think about an estate plan. There's lots of people that have, tremendous amount of assets and a tremendous amount of wealth, or have a lot of people relying on them that don't have an estate plan. So how would you approach that, Jen?
Well, the first thing is the conversation, the communication, but a will. And I could do a poll here to say how many people have a will, but how many people have updated in the last 5 years? And so the important thing is that as we talk about new tax structures that you might be implementing, is that your assets are changing. So if, in your will you had your land is going to kids and these assets, but now you own farm shares. And those are split between 3 kids, and now you don't want all the kids farming together if something was to happen to you. So you don't know what's going to happen from a tax perspective as well when your structure changes. And so it's important that you're looking at that will every year. The sad part is I think there's a negative connotation, or I know that's the feeling I get when talking to clients, because I think, they think about, they're getting out of the business and you're thinking about potentially death, but it's not. It's really just making sure you have things in place to contain and make sure your equity is going to go forward to the next generation. Because if we haven't looked at the tax side of things, there could be, a lot of your equity gone to the government, unfortunately.
So just what was the biggest thing holding anybody up before they signed their will? What was the biggest thing? Anybody want to share that? What is the biggest thing holding you up to getting your will done? Sorry, what was that? Oh, I didn't hear. Guys, what's your experience been? What's been the biggest holdup for clients that, they want to have a will and they kind of, we should get this done, and 3 years later you ask the question, so how's that will coming? Well, we haven't quite got it done. What's been the biggest holdback?
I think one of the biggest holdups is that we hear from clients is the value of farmland and the appreciation of value of farmland that makes it difficult to decide how we're going to divide it up.
So you're saying because farmland's gone up so high, people can't decide how to deal with it?
Yeah. And I think the other issue is that the government is too easy on farmers.
Well, you got a reaction anyway. They're awake.
I think that so I'll answer the first part, second part first. I think that, and Mike will confirm this because I'm not allowed to talk about tax, but because of the gifting rules with most farm property is that things can be gifted on a tax-deferred basis. So there's nothing that's forcing us to make a decision now that we can't make 30 years from now, the way that the tax rules are. While I should have gifted my land or dealt with my land to my kids 30 years ago, but I didn't, so I'm just going to keep holding on to it. And I think that it allows us to continue to push that down the road. The challenge, though, the argument that I would make about farmland is, do we think that farmland has been the best performing asset class in Manitoba the last 25 years? Right? That's the problem. Do we think that farmland is going to become a worse investment? So we're getting rid of it. Farmers are divesting of all of their farmland, right? Like that's what's going on, right? No, it's not going on. We're trying to buy more of it. So if it's still going to be a good asset investment class, then the problem is just going to get worse. So we have this double compounding effect that the tax rules allow us to defer the decision-making process, and the problem is going to continue to compound itself because farmland is going to continue to be a good investment.
I also find just with non-farming kids, that's a holdup because we're just not sure how, if we're leaving all this value to the kids that are going to stay farming, what are we going to leave to the non-farming kids? And I mean, if you leave the farming kids in with the non-farming kids in a corporation, for example, then you're having decisions made by someone who's not on the farm. And that's a scary thought for those, that are leaving the farm into the next generation's hands. And so you have to start looking at life insurance and what other, assets are available to make sure they're documented in your will so that those, decisions can be made.
Well, that's interesting because Jen and Peter, you've addressed a couple of things that I actually had written down because, when we're meeting with our clients on a regular basis, we talk lots about profitability and, what you buy this year and how we're going to depreciate and how are we going to skin the tax man or whatever the heck conversation we have. But, one of the things that is very important in not only a regular day-to-day basis, but in succession planning or transition, whatever you want to call it, is viability. Like a viable farm business, I would say, is probably quite important in the discussion of succession, right? You have to have something there that's going to either carry the load or that there's something there to actually transition, right? So there's only one pot to draw dollars from, and whether that's going to be to pay people or to pay debt or to live or whatever that may be. And if it's not viable, well, there's only a couple of, little options that we can probably take, which aren't likely very fun. So guys, what do you think is the, how should farm families address that viability topic? Because it's a real concern, right? When we talk about, buying farmland and paying for some farmland, I mean, some of this stuff has grown exponentially in value. So, anybody that's gone out and bought a new combine lately probably felt a little pain writing the check as well because these things aren't cheap anymore. So, yeah, how do we address that viability, guys?
Well, I would just say, at first, talking to clients is that we do need to sit down and look at cash flow. Like, we got to make sure we understand why this isn't viable. Is it because we've taken on too much debt? How much money are we going to have available for those getting out and for those coming in? Does it make sense? So it's really making sure, do we have a handle on that? Because you can look at the statement and say, this isn't going to pay for both of us. But do you really know that if you don't have your needs really out there and looked at closely?
Yeah, I think a huge piece of it is that in a lot of cases we're dealing with a whole bunch of pieces of the equation that we don't have the answers to. So if we're thinking about where people are going to live and what the cost is going to be, especially in situations if mom and dad have lived on the farm yard, there's been some good accounting done to cover some of their personal expenses as business expenses, but now they've moved into town. So, what are the property taxes going to be? What's it going to cost for personal fuel? What is our draw of the business actually going to be? And so I think we start with that. If we've got incoming generation, what are their needs of the farm going to be? And then, Terry, as you said, right, like, are we going to use... It's all going to come out of the same pool. So we add that. We need to pay down some debt. We want to grow the farm business. All of those things kind of happen together. And if it's not viable, then are we prepared to change our goals? Our needs, wants, expectations, and that's everybody in the business. Parents and incoming generation as well. And then, can you wait? And how long? Are you prepared to delay the plan? How long? What can be done in the meantime to try and improve the viability? And I think just because you can have a successful business, and that doesn't mean that it's a viable business for the transition component, right? So there can be a very successful farm business, and meet the needs of the current generation, but that doesn't mean that it's going to meet the needs through the transition piece. And I think in often cases we see that the cash coming out of the business actually goes up as we start to look at transition as opposed to go down.
You made a good point there earlier, Pete, about mom and dad and knowing sort of what they need to live on and stuff. So I've asked many questions, in the different family meetings we've had, and it's very interesting questions or very interesting comments and discussion we've had at the kitchen table. And they say, okay, mom and dad, I got my pen and paper ready, and okay, how much are you going to need to live? And they kind of look and say, well, I'm not really sure because the farm has kind of paid for everything I needed, and I'm not sure what I'm going to need. So then you kind of go through the list, as Pete said, property taxes and, maybe the odd trip to Hawaii or a couple of months in Mexico, whatever that may be. And then you say, well, what about income tax and that money that's going to come out? Mike, have you ever seen that?
Yeah, and that's to a lesser degree on the viability side. We can do a lot of really good planning leading up to that transition where we can keep the cost of mom and dad's retirement cash flow down. And I look at it the same way, and I think Tere hit the nail on the head. It's all coming out of one pot. So sometimes clients will look at me strange. They say, okay, in mom and dad's retirement, the farm's going to pay their tax bill. And people kind of look at me funny, and they're like, well, no, mom and dad are going to pay their own tax bill. Yeah, but the cash is going to come from the farm. So if we can set up a structure and we can do some planning ahead of time so that when mom and dad are pulling cash out of the farm, that their tax bill is reduced, then that puts less strain on the farm itself. Because if mom and dad want $2,000 every 2 weeks from the farm, if they're paying a bunch of tax on that, maybe the farm has to give them $2,500 every 2 weeks. Versus if we can do some planning, maybe take advantage of their capital gain exemption, maybe all they need to pull out every 2 weeks is $2,000. And that can go a long way over the term of a retirement, and it can ease the cash flow requirements on the farm.
So you finally got some exciting stuff. So tell me a little story on like how can we get some cheap tax dollars out of the companies, right? Like tell us more.
Okay, so this is probably the most common relied upon strategy that we use from a tax perspective. And this is going back to my comments earlier about partnerships. So one of the interesting things about farm partnerships, and this only applies for farming operations, is that when we put assets into that farm partnership and we wait 2 years, so the minimum is the 24 months, and maybe you've heard some information about that before, what happens is that partnership becomes a family farm partnership. Well, what does that mean? It means that partnership is now eligible for your capital gain exemption. So if we think about what we've done, we've taken things like inventory, machinery and equipment, bins and buildings, and all those assets, they don't qualify for your capital gain exemption. We put them into a partnership structure and we wait 2 years, and now all of that value qualifies for the capital gain exemption. So that's step one in a two-step plan. So get into that partnership, and you can operate in that partnership as long as you want. But when it comes time for transition or auction sale or however that's going to play out, the next step is usually incorporation. And that's where we can take that partnership interest, we sell it to that corporation, we use the capital gain exemption, so we're going to shelter all the tax. And what mom and dad are going to end up with is an amount that company owes them. And when they draw that money out, they don't pay any personal tax on it.
So is there any government people in the room? Because you better not tell anybody that.
Well, and the beauty of that, I mean, it's a good comment, but the beauty of that plan is the government is well aware of it, and they don't challenge it.
So really on $1 million then. So everyone knows we have $1 million capital gain exemption as farmers, right? We got $1 million exemption if we haven't used it, but that's what we have. Quick, Mike, like how much tax saving is that little strategy?
So for $1 million exemption, you're probably saving between $250,000 and $300,000 of tax.
Yeah, that's pretty good.
And so if you take, say, a husband-wife scenario, if all the stars align and each one can use their maximum exemption, you're now talking between $500,000 and $600,000 of tax savings. Now you're talking about a significant reduction in the cash flow that the farm operation is going to have to come up with to help mom and dad retire.
So as you can see, tax is part of it. It's not the be-all, end-all, but it certainly plays a lot of roles within it. Not only minimizing taxes, but also maybe maximizing what can be withdrawn out of the farm without, and providing a lifestyle to not only mom and dad, but also keeping the farm viable. So it kind of touches on a bunch of different topics. But you know, the other part of succession is having trained people, right? And trained people is, okay, so here's the situation. So I just sent my kid off to school. He's got his diploma or degree, and he's working at the farm now, and he's all, you know, ready, gung-ho, and, you know, just going to take over the world and wants to take over the farm. But are they ready to take over the farm? Right, you got to think about that. So, you know, they're 22 to 24 or whatever, you're 5 years old, depending on how long it took them to get through. But really, are they ready to take over? And sometimes we consider our farms to be, well, you know, a little small little business, right? But most of our farms are probably have more value and have way more dynamic things happening than the local, you know, store downtown, wherever, right? So I think there's lots of things going on. Sometimes we simplify that. So are they ready to actually take on the farm business, and are they actually adequately trained? I'm going to pick on Peter. Peter, what do you think some strategies for farm families are to make sure that the successor is actually, you know, has the skill set that they can take on this business? Because that's something we see a lot of now.
I think I often use an analogy of whether running a farm business is more or less complicated than being a plumber. So I think we can assume that running a farm business is more complicated than being a plumber, right? Well, to be a plumber in Manitoba, you need to take 4 to 5 years of school, a combination of school and work experience on the job training. And I think, and that's just to become a journeyman plumber. That's not to become a site foreman or an owner of a business. So I think in terms of strategies, the first part is just breaking down the decision-making process for some of those major decisions, and figuring out a way that you can involve the incoming generation in that. Instead of thinking it, like your agronomy or your crop planning, instead of it, getting them to put together the plan and then coming in and bringing that to the meeting, doing all the work to prepare for it. Or if you're buying new equipment, getting them to do, all of the research to tell you, what the best options are for upgrading equipment. Attending business meetings, whether it's with us or with the bank. We've got to, especially in grain farming and beef farming, is that it's an annual cyclical business. So if we don't take the opportunity once a year, then we've missed, we only get one chance a year. And I say, we're trying to get more than just overqualified equipment operators, because that's the stuff we love, right? We offload, the kids take on the things they love. We offload the things that we don't like cleaning bins. But we've got to also add them to the hard stuff and some of the things that we like to do, that we've got to be prepared to transition that to the next generation.
Yeah, that's a good point, Pete, because really when the original owners, mom and dad, I'll call them, are still in the business, and you're going to give, someone a chance, the next generation a chance to kind of start into that management role, well, you're still there to help them out, right? So if they kind of make a little misstep or a little thing here, you're still there to help, right? So that's way better than not being there to help them, right? So I think that's something we all got to really think about and say, hey, can we help them along and train them while we're here? Because the best mentor sometimes right there at home. Sometimes you don't have to look too far away to find mentorship and to find some success, because basically we can look around and there's been a lot of successful farms and a lot of successful farm businesses out there. We just need to transfer that knowledge, because boy, those kids they're ready to give, or they're ready to take on the world, like I said earlier, and we just can't wait to see what they're going to do with the opportunities that they get. So I'm going to turn it over. I want to ask you guys for some questions. Have you got any questions of the panel? Because while they're here, someone mentioned earlier, they're free. So you can ask them all the questions you want and they can't charge you. Any questions? All right, if not, we'd certainly like to thank you for coming and joining us here at the M&P Theatre, and to join our panel here for discussions this afternoon on succession. You've received the card, which we kind of touched on, all of the different facets that we believe are the important issues. We're going to be up at the booth in the next little while if you'd like to ask some personalized questions, and if not, there's some contact information there. So enjoy the rest of your Ag Days and have some fun looking at all the great exhibitors here today. So thanks for coming.
Peter, Jennifer, Michael, and Tere, thank you very much for sharing your knowledge and expertise with us this afternoon.
Thank you.